the bond market. Talk to me about it. Your view on this flip-flopping Fed and how you think the bond market's going to pick up on that story.
So again, the bond market is leading the Fed. The bond market led the Fed on rate hikes. It took a long time for the Fed to recognize that there was an inflation problem, that they needed to hike. And now the bond market once again is saying, whoa, wait, look at what's happening to the real economy. What I find really interesting, John, is that even though we've had this massive move in bond yields in the US, the dollar is stronger today. We are back at levels that we haven't seen since November of 2002. And what that tells you is that the market is even more worried about growth outside the US than it is here, and that the US is still viewed as a safe haven. So this is not just a US story, but as you read out from some of the quotes, this is a global story.
Mohamed, this feels like a new phase in this story of the market so far this year. It's not the same as what dominated the front half. It was pain in stocks, pain in bonds. Can you walk me through where you think this new phase in this market regime is going?
Yeah, John, and you know, I've found very simple construct are really helpful. And the simple construct I've had is the sequential move from inflation stroke interest rate risk to credit risk to possibly liquidity risk. So most of the first quarter was about inflation interest rate risk. And there everything sells off unless you are a commodity and you have supply side issues. But that's why your 60-40 portfolio was so harmful. The minute interest rate risk is mostly priced in and credit risk comes in, which is what has happened over the last few weeks, suddenly the correlations between bonds and stocks, the traditional correlations, when the price of one goes up, the price of the other one comes down, regains its footing. And investors have some risk mitigation, but then the impact is mainly on equities and on spreads. And the one risk I'm really worried about is liquidity risk. And we're starting to see markets locked out of funding. And keep a very close eye. Issuance in June was very low. Companies either were unwilling or unable to refinance themselves. So we need to look at issuance and make sure that that doesn't freeze up.
I was going through some of those numbers on the issuance side, and it's pretty dreadful for high yield. It's pretty dreadful for other parts of the market as well. When you talk about liquidity, Mohamed, can you just put a bit more detail on that, some more colour? Are you expecting liquidity problems to be where you'd expect traditionally for there to be liquidity problems, or liquidity problems to turn up in places where there should be liquidity?
So, you know, on my radar screens are three sets of potential, I want to stress potential liquidity strain. One is in peripheral markets that somehow contaminate the main markets. So far, crypto hasn't. So far, EM hasn't, but keep an eye on that. The second type of risk is simply the inability to raise funding at any cost. And again, we've seen high yield go through this, but high yield is less important than if it migrates up the quality ladder. And then the final one, John, which I'm surprised people aren't talking about, we would have expected major rebalancing flows by now to help equities. And we haven't seen that. So is it that they're being offset by outflows? Or is it that investors are less willing to rebalance in favor of risk asset? We don't know, but it is notable that we haven't seen the sort of rebalancing effects that you would expect after a quarter like we've seen in the second quarter.